You're listening to the greatest multifamily investment advice show. My name is Adam Ras, and now I'm talking everything multifamily for an in-depth conversation, and I will be diving deep into raising capital, deals, and underwriting process. Welcome back to the greatest multifamily advice show. Today we have Lior Rozhansky. Our today guest is the host of Invest in Multifamily show with more than 5 years on real estate business and syndication from Boston. Help me to welcome our guest today. How are you, Lior?
Adam, thanks for having me. I am excited to be on the show.
Thanks so much for being with us today, and I appreciate you taking the time. Let's start first on how you started your real estate career on multifamily. What was the beginning for you?
For me, kind of rewinding the clock, it's a very classic immigrant story. Like we were talking before, I moved here from an early age from Israel. And for my parents, it was always the dream of having me become a doctor, right? Like so many immigrants do. So I kind of went through school, studied pre-med. Actually ended up even submitting a couple of applications to med school after I graduated. But kind of fell into the thoughts of what do I do with my investment portfolio, right? Like how do I generate any substantial wealth? And after messing around with the stock market, like so many of us do, kind of came into real estate, right? I was always like a numbers guy, studied science in college, so I understood it, and the numbers made sense, right? You buy something, you've got a fixed cost on it. Hopefully, you're collecting more in rents, right? And you generate some cash that way. So, kind of plunged into real estate investing, bought my first deal here in Boston, where I'm from. Withdrew my apps, for med school from there, and then kind of launched my real estate investing career. I actually jumped in. I did a couple of condo developments in Boston. Learned the hard way that I did not want to do development. But really, and then shifted over to multifamily and multifamily syndication. And really started buying a lot of smaller multis in the Boston area, small multis, but expensive multis, as I'm sure we'll talk about. But yeah, that's kind of what I've been doing. And, because I think the Boston market provides one of the best opportunities for real sturdy wealth creation. That's what I've been doing. We've been partnering with a lot of partners around here that have provided capital for us. And we just continue to scale out a good size operation here in Boston.
I think your market is a little bit challenging because of the price starting point. And as we mentioned before, we're talking about per unit, about 400 to 500 per unit. So let me first just ask, what was the upside for you to choose a market like Boston versus markets like Atlanta, Tennessee, and Carolinas and South? What was the really upside for you to choose your market?
Yeah, so I guess I should kind of say the first couple of years when we kind of were launching and we're doing a lot of deals, we would look at kind of more developing areas around Boston, and I call those kind of maybe like high C, low B kind of areas, if you will. And over there, we were buying product, I would say between, anywhere from low mid twos to 300 per door, right? And, and that was fine. The cash flow created over there was pretty good. But over the last, I'd say 24 months or so, I've really made a hard shift in my business to really focus on class A and maybe higher class B sort of markets around Boston. And that's kind of where we started buying a lot of product in that price range, 400 to 500 per door, even 600 on our one recent acquisitions. And, a lot of people will kind of run away from that, right? They'll say like, what are you doing? It's just way too expensive. But, I think there's actually quite a bit of stability that comes in with that kind of pricing, right? I mean, if you really think about it, the Boston, New Yorks, you could probably even throw like San Fran and LA's of the world, right? Although California is a little bit of a different animal, but these kinds of major hubs, right? They've got inherent stability, and they've got inherent just opportunity for wealth, I believe, right? Because those markets are not going anywhere. There's just created infrastructure, very diverse economies. And, that's kind of what's really made us pivot, right? Is the idea of why don't we go buy some of the most attractive real estate in the world, where a lot of wealthy people are buying, and figure out how to create returns for ourselves and our investors.
Okay, so on this part, again, we're talking about the market fundamental in Boston and new hot area like New York. What you see is a long-term market fundamental, especially with new net immigration. Like everyone was saying that the winner is the Southeast. What you see is the actual impact of this on your market.
Yeah, I think during COVID, that was certainly a trend, right? Obviously, like New York, Boston, there's a lot of people moving from the north to the south.
Hmm.
I think actually that trend has stabilized quite a bit. Now you actually, if you scroll on your feed, you'll probably, I've seen articles of like why we moved back from Florida back to Boston, right? There's quite a bit of that. So I think that was really temporary. But in terms of market demographics, right? What I like about here, right, is we've got steady population growth, right?
Hmm.
I mean, we may have not hit it on the head like some of these southeast markets that blew up over the last couple of years,
Hmm.
and we don't really have that. But what we do have is just constant, stable growth, right? That's just not going to it's not going away, right?
Hmm.
And the reason for that is because the economies here are just incredibly diverse, right? I mean, Boston is a financial hub. It's a huge research, biotech, pharma, medical space. It's got some of the best hospitals in the world. It's got tech, and it's got some of the best education, right? I mean, Harvard, MIT, we got people coming in on a daily basis for that. So I think the economy here is just so diverse, and there's just so many things happening here that it's just hard for me to see. I think it would really almost take like a black swan event for a city like Boston to really get wiped off and not really see growth over a long period of time.
The implication of this right now, I think, is the recession. As we started already the recession on the last 6 months, we're still aiming until I think the peak of or the bottom of the recession is going to be, I think, at the end of next year. What you see is the impact of the recession on your market right now, price range wise.
Yeah, I think I'd have to almost like split up a little bit between core Boston versus if you go 30, 45 minutes outside of Boston.
Hmm.
If you go outside 30, 45 minutes outside of Boston, yeah, I think like a lot of markets across the US, I think you're going to see a little bit of stabilization happen, right? I mean,
Hmm.
obviously with interest rates going up, we just can't support the same pricing we were supporting 12, 24 months ago.
Agree.
So I think you will see a little decompression in cap rates. I think you're going to see a little, I think you're going to see some pricing stabilize. I would imagine it's probably going to be in the vicinity of 10 to 15% or so, is kind of what I'm seeing. But what's really interesting is actually in the core markets, right? If you're in Boston or within 10, 15 minutes of Boston, where, a large chunk of our portfolio is, what we actually see is people are still paying somewhat similar pricing, right? I mean, obviously it's not the same velocity or, it's not the same velocity or quite the same rigor. But at the end of the day, the people buyers understand what we're buying, and the sellers understand what they have here, right? I mean, these are legacy multifamily buildings that, a lot of times have very little vacancy, have demand very, very strong rents, are in some of the best locations and one of the best cities in the, some of the strongest cities in the world. At the end of the day, a lot of them are holding a little firm, right? So I think you're going to see maybe a little stabilization happen in these kinds of markets, but I don't expect a massive shift to occur, honestly.
Let me ask you something else. When you started, what was the really upside for you to choose multifamily other than like over the other different commercial spaces like offices or storage facilities? Why you choose multifamily?
Yeah, I think that was clear in my head. I mean, when I kind of bounced on real estate investing, um, I don't think I wanted to own something where I had to lease out to like a business, right? Because it just almost seemed inherently risky to me, right? Because what happens if the business doesn't do well, or there's any sort of issues, or it has a bad month, right?
Mm.
It did not really resonate with me.
Mm.
Where and we're talking, of course, very high level, right? But multifamily just it made sense, right? I mean, at the end of the day, people need a place to live, and if someone moves out, there's a ton of demand for housing, and I foresee that's not going to change anytime in the near future. Someone's going to just refill that unit right back up, right? Whereas opposed to, retail, office, anything like that, I think there's just a lot more risk in the tenant base.
Mm-hmm. I think before the show, we had a really good discussion about raising capital, especially during the recession. And I would like to ask you more about raising capital on two different models here as the syndication type or the fund model. So what was the upside for you and appealing for you to go more to the fund model?
Yeah, so we tested the fund model early this year. We did, it wasn't a huge fund. It was just a couple of $1 million that we raised to go buy some multis around Boston. Obviously the upside to a fund is, your capital's there, it's ready to go, and you don't have to go raise it on a deal by deal basis, right? I mean, from an operational perspective, that's huge. We could come in without really contingencies. We knew the cash was there. And it made it awesome, right? We were able to snag up some fantastic deals because of that. I would say obviously, on the other side, on the syndication side, right, or a more deal by deal side, I guess, it's kind of the opposite, right? I mean, obviously it's a little bit more operationally intense. You have to go raise the money after the deal's put under contract. But one thing I was surprised about is, I thought with the fund model, I kind of put on my resume, here's what we've done, here's the results we've achieved. I thought it'd kind of be a layup, people will be like, oh yeah, like I love it. Let's go invest in this fund. Let's go buy up the whole city. But I was actually kind of surprised. A lot of my LPs that I've worked with, they weren't convinced. I think it was just the model to them was very different, right? Like, I would get asked like, hey, what are you buying? And I'd tell them, well, we're going to find out, right? We don't have anything lined up right now. And that was just a very different framework than the deal by deal stuff, right? Because on a deal by deal stuff, you can see it. You can say, hey, here's the asset. Here's the exact projections for this asset. Here's the deal, right? Whereas obviously on a fund model, it's, you're kind of just going in blind. And, a lot of it is, of course, trust in the operator.
I think all of us right now have a lot of objections for raising capital, especially on recession. Can you tell me what was like one of the funnest or hardest situation to handle an LP, especially on the last 6-7 months?
Yeah, I mean, the last 6-7 months, I've actually had to raise kind of post-closing funds for one of my for a deal. There was a deal I bought last winter. We had enough funds obviously to close and do the stabilization, but needed some additional funds to kind of get it really across the finish line towards the end. And some of those conversations have happened the last handful of months as the market has started to shift, and those have been different, right? I mean, they certainly have been different. A lot of investors and, that have capital to deploy are a little bit, rightly so, a little bit less sure of where the market's going, what's going on, how everything's going to be impacted. So those are certainly different conversations than they were 12 to 24 months ago. The big thing that I kind of try to explain and I firmly believe in is, at the end of the day, this is why I'm buying these kinds of assets, right? Because I really believe these are going to be recession resistant. They're in the best locations, in one of the best cities in the country. We have a ton of demand, that rents are stable. So it's really more of an educational conversation, right? Of like, where do you think the market's going, and in particular in your particular market and asset class?
For sure. Let us jump into some different subject here is, how you describe the impact of the mentorship on your real estate career so far?
Oh, huge, right? I mean, like every investor that's scaled out, having people that you look up to, whether it's directly or indirectly through like mentor groups. I know we talked offline about that. I've joined some masterminds to kind of continue to improve my game. I mean, it's critical, right? I mean, at the end of the day, you can only go so far as you know about the opportunities you know about. So having mentors and people that you look up to that have done things on a bigger scale is just I can't say enough about it, right? I mean, I definitely wouldn't be here without it.
Especially on multifamily, it's a team sport, so you just cannot rely on yourself, especially on the beginning, on different aspects. One of them is, I think, financing, and yeah, I agree on this. Mentorship is really it's a team sport on multifamily.
Yeah, and look, I mean, I try to learn from everyone, right? I mean, I've even learned stuff from my property managers, from my contractors. I mean, it's a game that you're always trying to develop and get better at, right? Because the better you can get at it, the tighter your execution is going to be, the tighter your returns are going to be. There's no question about it. So it's not only from other investors, but literally from everyone, right? Like when I have conversations with more experienced investors, or even my lenders, like I said, my property managers, contractors, attorneys. You're always trying to figure out how do you take those lessons and kind of help them improve your game.
I think the second part is going to be, I think we're going to ask about what was the impact of having a partnership, especially on the GP side. What was the actual impact on scaling your portfolio so far?
Yeah, for me, I mean, partnerships have been crucial, right? I mean, I definitely wouldn't be where I'm at today without the partners that I've worked with, the current and past. I think it's critical, right? I mean, like you said, multifamily is a super complex sport. You need a lot of hands in order to really execute correctly and properly. I just find it hard to see how one person without a team, without a partner, can really achieve something like really amazing, right? And and this obviously leads to a conversation of like, well, how do you find partners and all that? And my approach always from day one has been, how do you provide some sort of unique value, right? And that's how I approach all my partnerships, right? When I was first starting out, 5-6 years ago, it was more me being on the ground, deal hunting, making relationships with agents, doing a lot of the dirty work, right? That was kind of my value to a more experienced investor. Today, I've kind of, I've developed a lot of knowledge in like the construction space, right? And so I lead a lot of that, dealing with tenant issues, stabilization issues, that kind of thing. So, regardless of where I'm at, I'm trying to figure out like, what am I good at? How can I provide value in that? And, who's the right person to scale out with?
Yeah. After 6 years on between multifamily and small multifamily and big multifamily, how you describe your superpower?
Oof, that's a good question. Tolerance and persistence. Because again, it's a complex sport, right? I mean, and there's, no matter how smooth a deal you think is going to go or how good a deal is, there's just always stuff that can easily knock you down, right? I mean, there's always surprises. There's always stuff that pops up. And I really think a lot of times it's truly a battle of attrition, right? I mean, it's whoever can survive the longest while still executing and delivering, I think is ultimately going to win, right? So I think that's kind of one of my, and I think that's a quality in a lot of investors that have scaled out big, is how do you do that, right? How do you tolerate? How do you persist? And how do you continue to, execute day in and day out?
For sure. Thank you so much for your time today. And my final question will be, how the people can follow your success?
I'm very active on social media. If you guys want to check me out on Instagram and LinkedIn, it's just Lior Rozhansky. If you guys are interested in kind of the value add model we do in Boston here, I actually put out a nice free kind of like resource on some of the big things I look for every value add deal. I'm happy to send the link on that. But regardless of how you want to connect with me, I'm all over online and social media. So
we hope to bring you again to the show to talk more about your success. And again, thank you for your time today.
I appreciate it, Adam. It was a blast.